The money flow index is a lesser-known relative of the RSI that incorporates the use of both price and volume. In this video, I'll explain how the MFI is calculated, how you can tweak its input parameters, and how you can use it for trend following on the dollar-yen.
The MFI is included in MT4 by default and is found under the volumes section. Like the RSI, it is a momentum oscillator that varies in the 0 to 100 range. Here's how it's calculated. First, compute the typical price over the look-back period. Compared to closing prices alone, typical price may provide a more representative picture of price action. A 14-period look-back is used by default. Next, calculate the money flow for each bar, which is equal to the typical price multiplied by volume. Money flow is positive when typical price increases from one period to the next, and negative when typical price decreases. Money flow is 0 when typical price is unchanged. With that, we compute the money flow ratio over the past 14 periods. And finally, we apply the familiar RSI formula to get the MFI. Since volume is included, the MFI is sometimes called the volume-weighted RSI. The MFI can be used in a similar fashion to other momentum oscillators. One popular approach is to use it to detect momentum divergences, which occur when price and MFI move in opposite directions. Since momentum often leads price, a divergence may indicate an upcoming market reversal. For example, a bullish divergence occurs when prices set lower lows, while the MFI sets higher lows. This could indicate an upcoming bullish reversal. Secondly, you can use the MFI to detect overbought and oversold conditions. Typically, MFI values above 80 denote overbought conditions, while values below 20 denote oversold conditions. Here's a comparison of the MFI versus the RSI, which typically uses 70-30 to denote overbought and oversold, respectively. Notice that the MFI is far more reactive than the RSI, producing more pronounced peaks and valleys. Despite its more stringent 80-20 threshold, the MFI ventures into the overbought and oversold regions more frequently. There are two simple tweaks you can use to minimize the number of false signals. The obvious one is to increase the threshold levels. Some traders use 90 and 10 levels instead. Another way is to smoothen the MFI by increasing the look-back period, up from the default value of 14. Here's how a 20-period look-back compares. Both these methods will cause a drastic reduction in trading frequency, so do tread lightly. To maximize my backtest sample size, I'll take the middle ground and use an increased 20-period look-back, but lower the overbought and oversold thresholds to 70 and 30, respectively. I'll use these MFI settings from here on out. The idea behind the strategy is to maximize value by jumping on board the long-term trend after a pullback has occurred. I'll use the MFI to detect short-term pullbacks. Here are the long entry conditions for the 15-minute dollar-yen. Prices remain above the 100-period SMA, indicating the long-term trend is intact. We have the 20-period MFI crossing above 30, showing the market is exiting oversold conditions, and that the long-term trend is resuming. For price confirmation, I will enter on a buy stop placed at the previous high, which will be valid for 3 bars. Rules are symmetrical on the short side, where you wait for the MFI to cross below 70. I'll now program the strategy in AlgoWizard. First we have the close above SMA condition. Next is the MFI condition. Just search for MFI and you will find a list of pre-programmed conditions. Select the cross above level condition and input the period and threshold. Entry will be on a buy stop at the previous high, which will be valid for 3 bars. For trade management, I'll use an 80 pip hard stop and an 80 pip trailing stop, which will only be activated after the trade has accrued 20 pips of open profit. I'll minimize weekend gap risk by exiting all trades at Friday 4 p.m. New York time. Since trend-following trades usually need time to develop, I'll add an entry condition that avoids opening trades on Friday. Using a fixed 0.1 lots per trade, let's backtest on the dollar-yen from January 2011 to December 2021. Not too shabby for such a simple strategy, although performance has declined over the past couple years. For actual trading, some form of variable position sizing should be used. Let's try a simple fixed fractional approach. A conservative 2% of account will be risked per trade. This produces 6.8% compound annual growth rate over the 11 years, despite the late drawdown. Of course, you aren't going to trade just one strategy. Having a diversified portfolio of simple strategies like these will produce good returns in both bull and bear markets. Be sure to like and subscribe for more backtested strategies. For more automated trading strategies, check out the video at the top right. To learn how to use genetic evolution to automatically build a diversified portfolio, check out the video at the bottom.